Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending November 10th, 2023. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is what's around the corner. We had a really good week or so, a couple of weeks actually. This past week was a little bit mixed. Why don't we get into where we are right now and what I see is where we're going through the end of this year. Um, if we look at the indexes, you can see just about everybody was in the green except for the Russell. Russell really had an ugly week. Um, Moved deeper into the red for the year, 3.18%. Nasdaq up very strong. S&P's regaining, going more towards the mid-teens, 15% year to date, and the Dow is just barely hanging on at 3.43%. We saw that um, the S&P came close to matching its longest winning streak in almost 20 years this past Wednesday, when the S&P notched its eighth straight gain, and Nasdaq was up 9 days in a row. But we had a little bit of turbulence coming in on Thursday, and then with a strong flourish on Friday. But it was one of the final weeks of Q3 earnings. There were really no upside surprises. Um, from some of the technology-oriented firms, although they did appear to provide a lot of support in the index. In fact, this week, the only sector that finished in the green was technology. All other S&P sectors were in the red for the week. Okay. You can see here the PE ratio, the forward PE is at 19.72. I still think it's higher than it needs to be. The dividend yield for the S&P is at 1.6. The 10-year Treasury is at 4.63. So the Treasury is higher by about 303 bips. Okay. Like I said, this past week, what ended that long daily winning streak for the S&P and Nasdaq was a U.S. Treasury debt auction. They had a pretty much large role in driving sentiment, both in equity and the bond market. On Thursday, the U.S. auctioned off 24 billion in U.S. Treasuries, and it did not go well. Right, it just did not, and it was the weakest demand, in fact, in 2 years. So that weakened the equity market. The other thing, the University of Michigan preliminary gauge of consumer sentiment, it fell unexpectedly to the lowest level we've seen in 6 months. So we had a couple of things that were moving the market lower. The other thing that added to it was our illustrious Fed chair, Power Ranger Boom Boom Powell. You know, he told a gathering at the IMF that the Feds were not confident that they had achieved a stance of monetary policy that's sufficiently restrictive enough. So the markets read that as there's still that option on the table of hiking the rates another 25 basis points. So that again, just that with the Treasury auction, lower consumer sentiment, we had that move lower on Thursday, and then we had that strong move on Friday back to the upside again. So a little bit of whipsaw out there. The current VIX, the prior week was at 14.91. This past week it came down just a little bit to 14.16. You can see the best performer for the week, the technology sector, and it was the only one that was in the green for the week. The worst, energy. And then year to date, technology has taken over communication services as the best performing sector for the year. Utilities is the worst. And it was almost just completely the opposite of last year. Okay. And then, of course, if we come over here and we look at the rest of the planet, we take a look over in European markets. You can see it was a mixed bag. Euro stocks and the DAX were the only two that were up, but just barely. The FTSE and CAC 40 were down. The FTSE over in London has also moved back into the red year to date. The speaking of the FTSE over in the UK, the Bank of England Governor Andrew Bailey, he said their central bank is really too early to talk about cutting rates. So, like the Feds, they're talking up another potential rate hike should it be necessary. Meanwhile, the GDP in Q3 in UK came in at literally zero. It had expanded 20 basis points in the prior quarter, but this one, zero. I mean, just flat. And in the European Union, the stats coming out of there also point to a weak economy. Okay, retail sales in the Eurozone fell 30 basis points in September. And that was after declining 70 basis points in August. So still going in the wrong direction. Meanwhile, the biggest economy in Europe, Germany, their industrial production fell in September 1.4% year over year, and it flatlined in August. We did see manufacturing orders increase just barely, but well below the expected 1.9%. So all of Europe is still hurting right now. Their economy is just barely flagging along. And if we go over the Asian markets, you can see over in Japan, the Nikkei was up 1.93% for the week. And coming in right behind Nasdaq, a still robust, almost 25% year to date, 24.81. All right. And the Bank of Japan governor there, Ueda, he warned that normalizing their short-term rates could be a pretty serious challenge for them. And we see the yield on the 10-year Japanese government bond. It fell from 91 basis points back to about 85, but still rather high. But what's helping the economy over there is the cabinet just approved extra money for Prime Minister Kishida to spend on his latest economic stimulus package, which is about 110 billion. So really the only two countries packing money into the economy instead of taking money out is Japan and then China. And if we look at China, they were just barely up for the week, down year to date. Hang Seng down for the week and down year to date. You know, equities rose over in China, but just barely. And I don't know if we're finding a bottom or it's going to go lower. I mean, we did see over in China, the CPI fell 20 basis points in October, while the PPI also dropped 2.6%. You know, it's the 13th consecutive month of decline for the PPI. And their overseas exports declined 6.4% in October, right? And that was further than the decline in September. So this is weaker global demand. We're getting some very weak numbers out of China. So, and China, keep in mind, is the second largest economy on the planet. So we're going to see global slowdown all over, including here in the US. What I want to do is shift the screen over. Let me just show you some of the charts. Members, we'll go into a lot more detail on our weekly market watch Sunday evening. If you're a non-member, I highly encourage you to come in, check us out. We're doing well. We're outperforming the S&P this year. So what I'm going to do is I'm going to take you to the S&P 500 E-mini futures. You can see here. As I said, we've gone very nicely on this, just moving, making lower highs and lower lows since beginning of August. And I had told you guys here in our free weekly roundup, as well as our members, to expect some downside August, September into October, and then a little bit of a flourish through the end of the year. You can see this move higher here, very strong on very weak volume. If we look at the volume, you can see how the volume has just moved down, except for Friday. Volume has been very anemic on this move higher. A lot of that is short covering. And then going into the weekend, I think there was some more short covering. You can see we're at my resistance zone right up here, which is the prior pivot high range. If we can't take that out, we're going to come back down. Now, you can see the Elliott wave count 3, 4, and for those of you that follow Elliott wave theory know that the next number is a 5 and it's typically lower than a 3. I don't think that's going to happen in this particular setup. I do believe that we're going to punch through this, although we did get Moody's doing a negative credit for the U.S. I don't know how that's going to affect the markets early in the week, next week when we open, but that hit right as the markets closed, right after the markets closed, rather, this past Friday. So this is kind of where we're sitting right now. You can see the intraday low. We were at 11.05% to the downside. So that meant a correction territory intraday, right, for the S&P. And you can see just this lower highs and lower lows. We've got to take out this prior pivot high and then find that as support to get back up into these the prior pivot high from that. All right. Otherwise, we're going to chop around and the odds favor going lower. If we look at the Magnificent Seven, right, which is NVIDIA, Microsoft, Apple, Amazon, Meta, Netflix, Tesla, and Google, you can see here it did hit 15.78% from the highs this year, but we're moving up fairly strongly. And we took out on Friday prior pivot high. So that typically means when you take out a pivot high or a pivot low, you come back and retest that level, and then it either succeeds or it fails. If it fails, we're going lower. If it succeeds, we're going to stay around these ranges and possibly have a strong finish into the end of the year for the technology sector. And FANG is very similar. If we look at the FANG, which is just the traditional Apple and Amazon and Facebook and Google, right? And Netflix, you can see here that we're near the highs for the year in the FANG, right? I mean, we almost made new highs. We were down 12.69%. And then we've come up and we're going to challenge these new highs. And typically when you get this close, I wouldn't be surprised to see us challenge these and actually take these highs out, okay? So that's a little bit about what these charts are showing here to me. If we look at Nasdaq, you can see Nasdaq also took out a prior pivot high, right? And it was down 11.97% intraday on this pullback here. But because we took out this prior pivot high, I'm going to be looking for a retest and a hold. If it retests and fails, then we're going lower. Okay, now the MACD would suggest it's going to roll back over again. We'll see how this plays out. You can see it's hitting almost perfectly my short term, medium term. My longer term support area is down here around 13,904. So we'll see if we get down there. And this would be through the middle to end of January of next year. Now, if we look at the Dow futures, you can see the Dow futures regained, moved back into the green, but just barely. I mean, the Dow futures are in the green by what, 3.43% year to date. We're challenging this prior pivot high like we are with the other indexes. Nasdaq's the only one that's broken the prior pivot high. This would suggest that if we pull back, it's going to find support right around the 50 or a 200 EMA. Okay, so this should hold. However, if we look at the Russell, this is the only fly in the ointment, folks. The Russell was down 18.78% intraday back over here on the end of October. That's ugly. That's almost bear market territory. To have an index, a small cap index in bear market, yet you've got the others solidly in the green, this bifurcation here is not going to last. And you could see this, we could not get above going into the green. We hit like a wall right around the 50 EMA. We hit that wall and now we're pulling back again. So this would suggest we're going to move lower. Okay. My target for the rut is down around 1519. All right. We're at 1707. Now, if we do break this and move lower, the other indexes more than likely are going to roll lower as well. Okay. So that's a little bit about what I'm seeing on some of these indexes. And then of course, if we look at the treasuries, you can see the bond market. Let's get the bond market up here. Here we go. You can see the 30-year bond moved up very strong, and then on that bad auction report, you can see it just came down hard, over two full handles. And my charts would indicate to me that bonds are going to move lower. We moved through my target, and we hit a 2023 low of around 107.04, right? And the chart would indicate we're coming right back down here again and possibly make new lows. That would mean, remember, if bonds go lower, interest rates go higher. And if interest rates go higher, it's going to put a lot more drag on the U.S. equity market. And if we look at the equity market, you can see this was my original target for the interest rates was around 4.5, and we topped out right around 4.99, right? That's where we topped out, right at 5. So I want to see how this thing shakes itself out, but this would suggest we're going to move up in interest rates, which goes contra to a flourish through the end of the year. But understand we're very thin breadth. Those 7 stocks, the Magnificent Seven, account for about 50% of the U.S. gains. So in fact, let me show you here the equal weight SPX. Let me just find that on here. If we look at where every stock accounts for 1/500th of a percent, we're still in the red year to date. All right, not pretty, huh? So if you take those 7 stocks out, it's an ugly, ugly time. It's just it accounts for over half of the earnings, right? Half of the earnings. So that's why the equal weight SPX is so poor, and why Nasdaq, I'm sorry, the Russell is also very poor as well. Now, if we come down here and we look at currencies, if we look at the dollar, it's hanging in there on the upside because no other country is doing well. You could see it regain the 50 EMA. And as long as the euro, yen, and pound stay a little bit weak, which they are, it's going to give a little bit of a boost to the dollar index. Remember, the euro is about 58% of the component value of the dollar index. The yen's about just slightly under 14%. The pound's just slightly under 12%. So when you add those 3 up, you know, you get pretty much the bulk of where the dollar index is going to go, right? And then, of course, if we look at the euro right here, the euro continues to make it's having a little bit of a move higher, but it's a bull flag right there. That would indicate the euro is going to move up and the dollar is going to move down. It's still in the red year to date, but we're sitting right on the 50 EMA, which is right below the 200 EMA. If we can clear out all of this, then I think the euro will be an interesting long. And then, of course, if we look at the Japanese yen, well, they just keep putting stimulus in the economy, but I think eventually this is going to stop and we're going to see the yen get on a long tear to the upside. This is my original target for the yen, and we've blown right through it, right? So that's a little bit about where I think the yen, longer term, the yen's going higher. I think gold is still coming back down a little bit more. I told you guys to not chase this up here, and here we go. Gold's probably going to find a little bit of support down around the 1900 area, or at 1942. You can see it blew beyond the 50 EMA down to the 200 EMA. This was my original target for gold. We blew right through it. Intraday, we were in the red this year and then just barely climbed back up. So I think we're going to stay lower here. There's going to be some downward pressure on gold for sure. And then, of course, if we look at energy, well, oil has just had a very weak time. Now, this is concerning to me. A big part of the move lower in oil has nothing to do with the Middle East. It has to do with the potential of a recession in the future. Oil comes down when supply outstrips demand. And demand goes down generally when the global economy is slowing down, as we see in Europe and China, which is a big buyer of oil and gas, and the U.S. The U.S. is the only pig in the poke right now with lipstick, but I think all of this is going to eventually wash ashore in the U.S. Still doesn't mean we can't have a flourish through the end of the year. The seasonality would call for it. But I do believe 2024 is going to have an interesting start to it. But anyway, you can see oil just coming down here. Any climb up is probably going to be met by selling to push back lower again. Okay. And then, of course, if we look at our trade here with Nat Gas, we've had a great trade on this thing. Our members have done very well, those that have followed along. But now it's coming to the lower end of this regression channel. I think it's going to come down, as I said, I think in last weekend's roundup. It's going to challenge that 2.86 area, and then we're going to see where we want to go. And that's a little bit about what I see with that as well. All right, everybody, that's it for the weekend roundup. I hope you have a great remainder of this weekend. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao now.